Okay, welcome back. I'm here with David Ryan, and welcome back to the Master Trader Program. We're going to, well, first of all, let's real quick just recap what we went over. We talked about categories and catalysts, the various categories, the leader, the top competitor, turnaround situation. So we also covered valuation and talked about how David and I don't really use the PE very much or any type of valuation book to price to book ratios or things like that. We're going to talk about that a little bit more later on as far as the PE is concerned. We'll talk about one of the ways that we do use the PE, but like I said, very seldom do we put much faith in the PE as far as for timing our investments. One thing we're going to talk about here today is what I call non-negotiable criteria and how it relates to the stock maturation cycle. This is something that I was introduced to from a man named Stan Weinstein, who many of you probably know. I met Stan back in 1990 in New York at a conference, and I was fortunate to have lunch with him. And we talked about the maturation cycle and his book that he wrote on this concept of these four stages. Of course, there's stage one, which is the consolidation, or I call it the neglect phase. Stage two is the advancing phase, where the stock is under accumulation. Stage three is the topping phase, where you're having distribution. And then finally, stage four is the declining phase and goes into capitulation, and then can go back into stage one again sometimes and repeat. So what we found is that when we look at the stages, or when we look at leading stocks that make big moves, and stocks that even make very fast moves, what we found was that 98% of those market leaders are in what we call stage two. Now, I've added some criteria. Stan Weinstein's criteria used to use the 30-week moving average. Now he's moved to the 200-day or the 40-week moving average. I use the 40-week moving average. I have 8 criteria, which we'll go over in just a second. So I've sort of added some criteria to that original concept. And now that's what we find, or what we call, a stage two uptrend. So real quick, Dave, why do we want to focus on stocks that are in a stage two uptrend? I mean, besides the fact that we studied all the big winners and the big moves are made in a stage two uptrend, but what does it tell us when we're in an uptrend versus, say, a downtrend, or even a sideways, bottoming phase that could take many months or years?
Well, in most cases, stocks are moving with the market and also group moves. And during stage two, that's where you get your greatest gains. And that's where you want to be long the stock. The other stages are, stages that you want to avoid. And if you can really get that picture in your mind of what the price and volume characteristics are of each stage, you'll be able to know when you're going from a 1 to a 2 and a 2 to a 3. So it's so important to just almost imprint the picture of what these stages look like and their characteristics as you go along, so you can recognize it when you're in one.
Right. And stage two tells us, this is one of the key things that we want to look for. We want to be on the side of institutions when they're buying the stock. We don't want to be trying to go long a stock that institutions are selling, because the market is, the price of a stock is moved by institutions. In the short run, you can get retail buying and you can get this smaller buying to move a stock a bit, but it's not going to have any sustainability. To make a big move, and these stocks like Amazon, or even much smaller moves than that, those are big secular movers. But even a relatively small move that's sustained is going to need institutional support. So we want to get on the side of that. So that increases the odds, or shows us that institutions are indeed stepping up to the plate. It also, if you take a look here, we're looking at Weight Watchers, and just looking at the 4 stages, you see that you're either losing time or losing value in the other 3 stages. In stage 1, you could be sitting in stage 1 for years. I mean, Dave, I've seen stocks go for I've seen stocks go sideways for decades, but certainly for years, right?
Oh yeah. Well, even the best stocks, like Microsoft, made a great move from the 80s all the way up to 2000, and then sat out for 16 years before it started a new uptrend. So that's 16 years of where your money is actually losing value because of inflation. And other ones like Cisco hit a high in 2000 and is still not exceeded that high. So sometimes it can go on for a long, long period of time. I mean, you just don't want to give up that time.
Dave, are you ever going long? Is there a reason, maybe like, the fundamentals are good or you love the company? Are you ever going long in a stage 4 downtrend?
No, I would be either avoiding the stock totally or looking for a spot to short the stock on a rally.
Right. That's where we'd be looking to short stocks would be. And we're not going to talk about shorting because David and I both don't do a lot of shorting. We're mainly on the long side. We feel that's where the opportunity is. But if you were going to do any shorting, it would be in a stage 4 downtrend. That's where that would be the reverse of a stage 2 uptrend. Now you're going to go short. And now, the other thing is when you have this stage 2 uptrend, you've got momentum on your side. And the key, what Dave was just saying about this time value of all this time that goes by where the stock's not moving, whether it's in stage 3 going sideways, it's in stage 1 going sideways, you're losing time, and time is very valuable. So you want to be able to move from one stock to the next, and you want to compound your capital. So the quicker a stock makes a move, the sooner you can make that, you can capture that upside, and then you can move into another stock that's in a stage 2 uptrend. Let's look at a few more examples and just show you how this looks. You'll notice that the real action starts once you're in that stage 2 uptrend. When you're moving sideways, you may be whipping around, and maybe if you even you grab the low, you get a pretty good move. But the real big move happens during the stage 2 uptrend. And like I said before, when we look back and we look at the big movers and the leaders, 98% of them made their big move when they're in stage 2 uptrend. And that's what we call non-negotiable criteria. That means that we're not even going to really look at a stock. We're not even going to consider it unless it's in a stage 2 uptrend. Again, we'll look at Crocs here. Even a stock that was a recent new issue, it comes in and here's where it's making its big move into stage 2 uptrend. Sometimes your stage 3 is quite quick, where you don't spend a whole lot of time topping, and it morphs very quickly into a stage 4. So sometimes you got to be quick on your toes to get out there when you see it, shifting. The other thing I want to point out, and this is an Amgen stock that I bought. I know Dave was involved in this stock back in the 90s. This was a big stock for Bill O'Neill. You'll see that sometimes what happens is you get into that stage 2 uptrend, you go to a stage 3, you come back into stage 4, and that doesn't mean the stock is done. But it could, right? You don't know, and you're managing it in real time. So when you're in the stage 4 downtrend, you want to be out before that even unfolds. However, it can reassert itself, and who knows? It could be a year, it could be 5 years, and then get back into a stage 2 uptrend. And as long as that criteria is met all over again, you can get back into the stock. Let's take a look. JetBlue. So this is where this would start to get on my radar. Now, here's really something to take a look at. Look at the contrast here in volume. Here you're in the stage 1, where the stock is just moving sideways. And as it starts to turn up and it gets into stage 2 uptrend, this is where it hits my radar, and I would be beginning to look at it, all right? And I might not even be interested in it until it forms a base within what I call the confirmed stage 2 uptrend. We're going to talk about that in just a minute, the difference between an early turn and a confirmed stage 2 uptrend. Once it's in that stage 2 uptrend, that's where the real action happens. Look at the difference in the volume. See, this is institutions. Look at all that big volume relative to this very low volume. That's where the institutions are now coming into this, and they're stepping up to the plate.
And the other thing to know is that if you don't get the first move in a first stage uptrend, there are usually 3, 4, sometimes 5 moves where there are proper bases built between those different moves. And so even if you miss the first move, you can get the second. If you miss the second, maybe you get the third. So don't hit yourself over the head for missing the first move, because if it's a great stock and it's going to be going for 18 months, you'll have another chance at it sooner or later.
Yeah, and this is where I was buying Lulu. Lululemon was coming out of this base right here after it was in a stage 2 uptrend. And then you can see you formed a bunch of bases as you marched its way higher and higher until you finally went into this stage 3. And then you had that, look at that big move down, the big volume. That's where you're just starting to go into stage 3. You're getting the liquidation phase, and then you turn over into the stage 4, and you should be out long before that. But you get a lot of chances. Sometimes you'll get you'll get a bunch of different bases that form. Sometimes you won't, but usually you get yourself several opportunities. As a matter of fact, very often what happens is as the stock gets popular and starts bringing even retail investors, and maybe the name or the business really starts to get going, you can get some of the biggest moves actually in the later bases, in the second, the third, and sometimes even the fourth stage base, where the stocks blow off and then they make very big moves. Go ahead, Dave.
Yeah, and Mark, the one thing I would like to say about the difference between stage 2 and stage 4 is they're almost exactly the opposite of each other in terms of the way the stage 2 stock acts. It moves up quickly on big volume and it drifts while it's building a base, and the volume lightens up. On stage 4, it's exactly the opposite, where the stock comes down on heavy volume and then rallies on lighter volume, and just cannot get traction, cannot make up a lot of those big drops that the stock has. So stage 2 and stage 4 are exactly mirror images of themselves in how the stock acts.
Yeah, and I want to point out a subtlety. This is something that actually I learned from Dave years ago. It's a subtlety, but once you learn how to spot it, it's not so subtle. And like Dave said, the complete opposite. And we're going to be talking about this later too when we look at daily charts. Right now, we're looking at weekly charts, but this same exact concept works in all time frames. Take a look how you move up very quickly here, right? And then you take a whole bunch of weeks to pull back, and then very quickly in just 1 or 2 weeks, you come all the way back. This is this is the tennis ball action that I always talk about, but this is marrying the tennis ball action, right, with the fact of you're looking at the number of days or weeks that it takes you to drift back, and then you make it all up. Now, right here, look how you come back, right? And then just boom, 1 week, you make up all the lost ground. Look right here. You got a whole bunch of weeks, and then 1, 2, 3 weeks, you make up all the ground. Same thing happens over and over through this entire uptrend. You can see that same characteristic. Now look at here. Boom, big down move. Now you take all this time to drift up, and then wham, you erase it. See, you move sideways, wham, you erase it. Again, takes all this time, boom, just a couple weeks, and you're back in new lows. These are the characteristics that you want to look for, and you want to see, of course, the up moves being quick and the down moves drifting, and also you'll look at the volume during that time, and you'll see that the volume will be explosive on the upside and then will contract on the down move. This is a concept or a technique that you're going to use on all time frames. Now, looking here also, and if you remember, there was a very popular, I won't mention any names, but a very popular investor that was buying this stock. If you remember, Valiant Pharmaceutical, and this came below the 200-day, right? Went into a stage 4 downtrend, and this is where no matter how good the story is, no matter who's buying it, no matter what you hear on the news, you should be avoiding the stock. The stock is telling you, and even some of the smartest investors that were buying this all the way down, and then this stock went down 93% in just 15 months. And again, there was, people buying this stock, hedge fund managers buying the stock, and people that believed in the story. You really got to keep your eyes peeled here for the trend, and make sure that you always have the wind in your sails. The trend is your friend. There's a reason why that saying has been coined.
Yeah, and the other thing on that example is one of the most basic rules is that you want the stocks that you own should be in an uptrend above the 200-day moving average, and that 200-day moving average in an uptrend. When that started rolling over and that 200-day moving average started dropping in November of that, it looks like November of 16, that you should have been out. And that's how all your stocks should be. You should only be in stocks that are in, as we go back to the beginning, stage 2 uptrends.
That's right. Now, just think of it as having the wind in your sails when you're in an uptrend. And then when you come under the 200-day and the 200-day rolls over, now you're going into the wind. You're trying to sail into the wind, or you're trying to swim against this big tide. Now, we're going to show you in just a second. There's the 8 criteria. We're talking about the 200-day, but there's some other criteria too, and I'll show you that in just a second. Now, here's the interesting thing where this is a stock that I actually added to our short list for our clients, but it was a long. So you can see here, this was what we call a power play, where the stock moved up real rapidly after you had an IPO, and then it formed this little base right here. This was what we call a power play, or also referred to as a high tight flag as well. And then you see you make a nice quick move. You're able to capture a real nice move here in just, 10 weeks or so. And then that stock starts topping. And now it rolls over, and now it's a short. That same stock is a short, all within, a time frame of, just a couple years, and then rolls over. And look at this, boom. Right? Because now the momentum is to the downside, and now you get the same type of situation that you have here on the upside. You're getting in reverse, as Dave said, on the downside. Now, another thing to talk about too is that you can transition. You don't have to. You could be in a stage 1. You don't necessarily have to go from stage 1 to 2 to 3 to 4. You could go 1, maybe briefly in 2, and go right into 4. You can go from 1 to 4. The key is to gauge what stage you're in at any one time. Not worry about the chronology of it, but just make sure that you're in the correct stage. So here's a stage 1 that's breaking out. Nice base here. And you can even buy coming out of a stage 1 if it's just turning into a stage 2. And we'll talk about that later on. It's what we call an early turn. But you have to be very careful when you just get in, when it's just starting to turn up, because you don't have that confirmation. It hasn't proven itself that trend is going to hold. And this was going right into the the banking crisis here, and going into the 08, 09 decline. And this is Citigroup. All right, Citigroup comes out of a nice base, and you've got to always be ready to switch gears. I always say if you're in cash, you got to be prepared to go long. If you're long, you got to be prepared to go to cash. Always entertain or always be prepared for the opposite side of the trade. So, don't form an opinion here. It came out of a big base. Oh boy, I'm in a stage 2 uptrend. Everything's okay. And now it quickly rolls over. Now, of course, if you had a stop loss, you'd be knocked out of this. Something like, Bank of America here, same thing. Came out of a base, gets into a stage 2 uptrend, and you should be selling here. Whereas your first point where this is not acting so well, if you didn't sell there, definitely here, and without a question here, because now you're rolling over and you're really starting to turn into that stage 4. So if you know these stages, you're going to know if you should be entertaining the stock or not even thinking of it. Now, you remember earlier I talked about how we're going to start at a satellite view, then we're going to come down to an aerial view, then go to an overhead, and then to a microscopic view, and really get right down to the buy point, specific days, volume analysis, and price, right to the very day of the buy point and selling rules. Right now, we're just starting to come down a little bit and go to maybe an aerial view, right? We gave you that big perspective talking about the categories and valuation. Now we're coming down to an aerial view. Still, though, this is still perspective, but we now have some real rules, right? Where this is also applicable. These are decisions that or things that you're going to look at to qualify the trade. All right. So you want to. This is what we call a qualifier. Non-negotiable by criteria means that this isn't open for negotiation. Right? There's not, well, but, it has big earnings, or, well, but it's Amazon. This is, if the stock is not in a stage 2 uptrend, you avoid it. And you should be setting up, and I'll show you later on in MarketSmith, there's some, my templates are in there. So you don't need to go and program this or worry about it. There's some already pre-programmed formulas in there that you can run. And we'll do that a little later on. I don't want to get to that just yet. So another thing too is, don't get enamored with bank or upgrades or recommendations from, Goldman Sachs put it on their buy list, but it's in a stage 3 or a stage 4. This is a perfect example. I always like to show this. We put this stock on the short list. We initiated this as a short alert on July 9th of 2012. Just shortly after, all right, 5 days later, Citigroup upgrades it to a buy. And 3 days later, look at this. Pow, it gets creamed. 3 days later, it's down 23%. Comes down much more, has a brief rally, and just gets annihilated. And the stock almost cuts in half. This is after Citigroup puts it on buy. So again, don't get enamored with brokerage firm upgrades or buys, or whether Kramer or whoever's talking about it. The stock is telling you that the wind is in your face now, and you got to avoid the stock. Do you even pay attention, Dave, to upgrades from brokerage houses or anything like that?
No, and lots of times brokerage firms, houses sometimes upgrade the stock, and their clients sell right into it. You just have to look at the market action itself, and not let opinions of other people. You can do, with the right rules, the right set of rules, the right discipline, you can do so much better than most analysts on Wall Street.
And what Dave just said, that really pretty much sums up what we're doing here. We're going to give you all the tools and everything so you could be independent. You can make these decisions on your own, and you're not going to be able to have to ask anybody's opinion, or you're not going to be able to have to look at newsletters and listen to the TV and all the pundits. You're going to be able to make these decisions on your own. Now, this is a term that years and years ago, when Dave first started doing the Master Trader program with me, he termed the serial gapper, and it couldn't be any more apropos, if you will. What happens is, when you're in an uptrend, you get a lot of happy surprises. Stocks gap up. They do well on earnings reports. You get happy surprises. It's a serial gapper on the upside. But when you go into a downtrend, it just the opposite happens. So you increase your risk of volatility. You increase your risk of waking up the next morning and having the stock be down big on a gap. A lot of times, even on good news, the stock will gap down. And so this is a perfect example. This is another stock that we put on the short list as it broke through the 200-day. I put it on the short sale alert list, and look at all these gaps. Look at all the way. And then at the end, they really start to accelerate. And this stock is another stock that cut itself in half. Again, this is a good time to talk about the 50-80 rule. So another thing that we've gone back and looked at, and I talk about this in my book. O'Neill talks about it in some of his books too, about the kind of decline, the average decline that a stock will go through. A leader, a past leader, a secular leader, that once it tops, the average decline is 72%. And this is a rough rule of thumb, but it's a rule that I've come up with. I call it the 50-80 rule. 50% of past leaders, once they top, will go down 80%, and 80% will go down 50%. That is a very sobering statistic. It's a scary statistic if you start holding stocks in stage 4 downtrends and you're in a prior leader that tops. This happens all the time, and this will happen with Amazon. This will happen with Google, with all these names that everybody's completely convinced that they can never go down 50 or 80%. I assure you that Amazon, Google, Netflix, PayPal, all these names that are these Facebook, that are the rocks of Gibraltar of the market here. I assure you that at some point, those stocks, the 50-80 rule, they will succumb to the 50-80 rule. It'll be too late. If you're sitting there trying to buy them in a stage 4 downtrend, you get yourself in big trouble. It might blow your account up.
Yeah. And I just add, do not fall in love with your stock. I mean, yes, it's great when you're aboard a stock and you've held it for months and maybe even a few years. But when the characteristics change, you've got to not treat it as your own little baby and I can never sell it. Well, you can see just in some of these examples what can happen when a downtrend starts. You have no idea how far it can go. So you just, and I know people get enamored with certain names. I've got to own this. I've got to own this. But there always comes a time where those great names can underperform for much, much longer than you can ever think.
Yeah, and I'll follow up on that by saying, look, first of all, if you're going to fall in love with the stock, you fall in love with it while it's in a stage two uptrend. You're never going to fall in love with the stock once it's in stage three, stage four, or even stage one. But if you're going to fall in, but here's the thing: you don't marry a stock. All right. You may hold it for a while. You date stocks. They're not to be married. I know some people, if I held Amazon all these years, first of all, you wouldn't have held Amazon. If you bought a stock and then it went up, I don't know, 1,000%, you'd probably sell it at some point on some correction or take your profit. Now it goes up 5,000, 10,000. Very few people are going to hold a stock for an 80,000% move. But here's the main point. Plan for a divorce. Okay. At some point, you're going to get a divorce from your stock. You're going to have to get it, whether it's forced or it's something that you planned for. There will be a divorce. I assure you, at some point, all stocks, you will end up having to have a forced divorce. So don't marry them. And if you do marry them, plan for a divorce. All right. So real quick, this is I'm not going to go through this, but this is the transition criteria. So when you're watching stocks, if you're watching stocks maybe in stage one bottoming, a lot of people are like, well, I want to get a lead ahead of it and watch it before their stage two. I can get it right when they turn to stage two. Like I said before, I'm going to show you in just a second. We have some screens in MarketSmith that you can run that'll show you that transition. But if you're not using MarketSmith and you're just looking at stocks, these are the transition rules. This is what you want to see on the daily and the weekly. I just put that out there for you. You can look at that at your own time. But real quick, why are we trading with the trend? As we started off the conversation, why do we trade with the trend? 98% of the biggest movers and the fastest movers were in stage two uptrend. That's compelling enough. That for me, that's enough. Do you want to be in the 98% club, or do you want to be in the 2% club? Do you want to have a 2% probability of being in a big moving stock or 98%? See, if you're in any other stage than stage two, based on history, you have a 2% chance of being in a big winning stock because 98% of stocks are in stage two before they make a big move. So right there, you've killed your probabilities. Now, the other reason is because we want evidence that institutions are buying. We're going to talk about that later, even more in depth, why we want institutions buying and to be able to ascertain whether they're buying or not. That's something we're going to get into in depth throughout the entire workshop. You're also going to increase the probability of success because, like we said before, you're going to get bailed out more often. You're going to get happy surprises with a serial gapper to the upside than a serial gapper to the downside. You're going to have stocks that are going to respond to news better, even bad news. Sometimes they'll go up because they're in this uptrend and there's an appetite for the stock, as opposed to in a downtrend, even good news, the stock will come off. And here's even a more important reason, and this is what we're going to get into very much detail later on. You know what to expect. You see, we have to narrow down the market to a set of parameters that cuts out a lot of noise and cuts out a lot of the other selections, the potential selections, because we need to know what to expect under certain conditions. It's all about reference points. See, David and I have been doing this so long that when we see a stock, we immediately, our eyes are like a template. We just overlay it, and we can look in 2 seconds and see if it's meeting the criteria that we're even willing to consider it. And we could just throw it out or consider it right away and just start narrowing it down. And we know what we need to see. And then under those conditions, we know what to expect, to whether the stock's acting normal or abnormal. Under this particular condition, this is what the stock should do. The stock should be showing us tennis ball action, having pullbacks that are on low volume and very quick moves back up. All these characteristics that we're going to be going over, we know what to expect, and that's all you need to know. You don't need to forecast. You don't need to have a crystal ball. You just need to know what's normal and what's abnormal. And like I said, we'll get into that very much. Now, remember, your goal, here's the real key, because everybody has this buy low, sell high. Your goal is not to buy at the lowest price. Your goal is to buy at the right price. So what is the right price? The right price is that when you buy, the stock goes higher before it stops you out. without stopping you out, the stock goes higher. So if you bought at the lowest price and the stock sat there for 2 years before it made a move, that's not what you're trying to accomplish, because you lose all that time. Or if you bought at the lowest price and now it goes down an amount that hits your stop, well, that's not going to help you either, because you're going to be knocked out of the stock, and then it might turn around and go up and you're not even in it. So the key is to buy at the right price. You'd much rather buy, maybe the stock doubles or triples, but then from where you buy it, it doubles again. The key is what it does after you buy it. And that's the real key that we're going to be talking about here. Dave, I don't know if you have any final comments on that.
Yeah, I would just add is that when you're in a stage 2 uptrend, or is that you're looking for change. If the stock is going up and it's got a nice trend going, it's when things start changing is when you should be aware of maybe that stage 2 is over and we're going into stage 3. So you're always looking at the price and volume. You're looking at the characteristics of how the stock is trading. And once you identify that change, you might be getting ready to be selling that stock.
And I'm going to show you later on, because some people say, oh, this is long term. And, and what about the shorter term trades, the swing trades, or even the really short term trades? This criteria is the same criteria if I'm day trading a stock, swing trading, or trying to hold it for a big move. I'm still requiring all this criteria from my buy point. So we're going to get to that later. Here's the trend template criteria. All right, this is also in my books. Many of you may have seen this already, but this is the criteria that you're going to want it to meet. Now, here's the important thing. It needs to meet all of this criteria. It's not like if it meets 7, it's okay. It needs to meet all this criteria to be a confirmed stage 2 uptrend. Now, in MarketSmith, if you go to reports and you go to technical, in the folder technical, there's going to be 4 Mינארווני trend templates that are going to come up. There's a 1 month, a 1 to 4 month, a 5 month, and a 5 month, we call a 5 month loose. We're going to have Arusha from MarketSmith here on live trading. So I'm not going to get into this too deep, because we're going to go into all this, and he's going to show us MarketSmith, and you'll learn a whole bunch of things about MarketSmith, and we'll look at these in depth. But all these screens for finding an early turn, a transition from stage 1 to stage 2, it can be found in the 1 month and the 1 to 4 month, and then confirm stage 2 uptrends can be in the 5 month, and then the 5 month loose lets you add additional criteria that's not in there. Now, the real cool thing is that you can use these as a qualifier. So you can screen the entire market. It screens them out based on my trend template. And then from there, you can add criteria. So you don't even get tempted to buy some stock that doesn't meet this criteria or that's in a downtrend. Real quick, also, you can go on MarketSmith. There's up in the right-hand corner, it says open stock ideas. And if you click on that, there's a shortcut. And you go right here, just under the William O'Neill screen is the Mינארווני trend 5 month. If you click on that, it's under weekly uptrend. You click on that, and then it will go and it will take you to this folder, and you'll see all 4 of them. So that's a little shortcut.
Yeah, and Mark, one thing I would add to that, when I spend a lot of time, or at least every week, I'm looking at the 1 month trend template. And what's interesting is that can actually give you some feeling for the market. Is the market starting to turn, or has the market been going for a long period of time? Because when the market's been an uptrend for a long period of time, you're going to get fewer and fewer stocks that are showing up in that trend template. I mean, you're going to get like under 20 stocks. But when the market has gone through a correction or has gone through a bear market and then starts turning, you're going to get hundreds of stocks showing up that are just starting to turn. And you can also get a great indication of what groups are starting to move when you see a bunch of stocks that are hitting that trend template.
That's right. You can sort it by group, and you can see right here when this was run 872 stocks. I remember when we were in the correction, in the bear market correction, it was down. It was way down. I think it was 100 names or a couple hundred names. So yeah, I know a lot of people have mentioned that they look at that and see the health of the market based on how many stocks are in the uptrend versus the downtrend. And that's something also that Stan Weinstein used to do. And I think he used to have a newsletter called The Professional Tape Reader. This was way back, many decades ago. But he used to rank, how many stocks were in the various trends. And that was very helpful in understanding where we were in the maturation cycle of the overall market. So early turn, real quick, is when we first turn up and you get the 200-day is only up in an uptrend for 1 month. So it's very early in the transition from 1 to 2. A confirmed stage 2 uptrend, now we're in an uptrend for greater than 4 months. And usually you stair step your way up from there, and now you've got all the criteria met, but you're in an uptrend with the 200-day for over 4 months, and that's what I call confirmed. And that's the majority of the stocks that I buy are in the confirmed. Now, real quick, we're going to talk about this later about power plays, high tight flags. They move up so rapidly from the lows, they can actually transition from stage 1 to stage 2, but be in an early turn. So that's one of the reasons why you look for the early turns, and you can run the early turn screen, is you'll find some of these power plays that go from dormancy to just boom, off to the races. They double or triple in a very short period of time. And you're going to need to apply the early turn criteria. So there is some caveats. A confirmed uptrend is what you want the majority of your stocks, but for the power plays, you can sometimes get them where they're going to be in the early turn criteria. And the last but not least, if you get a very large base, you get a base that's moved sideways for a long period of time, and usually a double bottom or some type of base that forms over a long period of time and has either a dip on the right side, or maybe is forming like here, low on the right side, you can get where the moving averages flatten out, and then it comes out of these bases and you're in that early turn also. Those are just two quick caveats that I wanted to cover. We're going to get into all this deeper and deeper and deeper. When I mean deep, I mean deep. So this is, again, we're just giving you the perspective, and we're looking at that aerial view now, and then we're gonna come down into an overhead and then get really microscopic. So just hold on to your seat here, and there's a lot of fun stuff coming. So when we come back, we're going to talk about fundamentals, because we also, we're going to talk about technicals. We started off with some technicals and some group work. We talked about categories, valuation, now the trend. We're going to add the fundamentals, and then we're going to go back to the really, really fun stuff to get to the chart patterns, and then later on risk management, of course, and talk about IPO bases and power plays and everything you can think of under the sun. The math behind all this, risk management, everything you can think of from A to Z. So, but we're going to take a break right now, and then we'll be back, and we'll go to fundamentals. Okay.